Hello, folks. Tonight on Last Week Tonight, we're diving into the thrilling world of tax accounting. Don't change the channel yet. It's way more interesting than it sounds, especially when we talk about something called the tax accounting equation, or TAE. It's like a secret weapon against those who try to avoid paying their fair share. This ingenious tool was developed by a brilliant mind, Dr. Joko Ismuhadi Soewarsono. Imagine a mathematical formula that helps us understand a company's financial dealings. That's essentially what the TAE is. It looks deceptively simple. Revenues equals expenses plus the difference between assets and liabilities, but don't let that fool you. This equation is a powerful tool for tax authorities. It connects the dots between a company's income statement, which shows their revenues and expenses, and their balance sheet, which lists their assets and liabilities. By analyzing these components together, the TAE shines a light on any discrepancies that might indicate tax shenanigans. It's like a financial lie detector test, and trust me, some companies would fail miserably. Now, you might be thinking, John, how exactly does this equation catch tax dodgers? Well, hold on to your hats, because this is where it gets really good. The TAE helps tax authorities spot red flags that suggest a company might be trying to pull a fast one. For instance, if a company reports sky-high revenues but their assets haven't increased proportionally, that raises a big red flag. It could mean they're underreporting their income to pay less in taxes. Sneaky, right? The TAE also helps detect more complex schemes, like companies inflating their expenses or hiding assets. It's like a financial puzzle, and the TAE helps us put all the pieces together to see the bigger picture. This is crucial because tax avoidance and evasion cost governments billions, if not trillions of dollars every year. That's money that could be used to fund essential public services like healthcare, education, and infrastructure. So, yeah, the TAE is a pretty big deal. The beauty of the TAE lies in its versatility. It's not just a tool for tax audits, although it plays a crucial role in those. It can also be used for tax planning and financial analysis. Businesses can use the TAE to make sure they're operating within the bounds of the law and to identify potential tax savings. Investors and analysts can use it to assess a company's financial health and risk profile. It's like a financial Swiss Army knife. The TAE offers several advantages over traditional methods of tax analysis. First, it's comprehensive, considering both income statement and balance sheet data. Second, it's objective, relying on quantifiable financial figures rather than subjective interpretations. And third, it's adaptable, allowing for customization based on industry, company size, and other factors. In a nutshell, the TAE is a powerful tool that promotes transparency and accountability in the tax world. And in a world where corporations often seem to play by their own rules, that's a very good thing. Now, before you go out and get TAE tattooed on your knuckles, it's important to understand that this tool isn't foolproof. It has its limitations, just like any other analytical method. One major limitation is that the TAE relies heavily on the accuracy of financial statements. If a company is cooking the books, the TAE won't be able to detect it. It's like trying to solve a puzzle with missing pieces. You'll get a distorted picture. Another limitation is that the TAE primarily focuses on quantitative data. While numbers are essential, they don't always tell the whole story. Qualitative factors, such as a company's business model or management practices, can also influence its tax behavior. Finally, interpreting the results of the TAE requires expertise in tax accounting and financial analysis. It's not something you can just Google and master overnight. You need someone who can connect the dots, see the patterns, and understand the nuances. Despite these limitations, the TAE remains a valuable tool for promoting tax compliance and fairness. It's a step in the right direction, but it's not a silver bullet. To effectively combat tax avoidance and evasion, we need a multi-pronged approach that includes robust regulations, strong enforcement mechanisms, and a culture of compliance.